Our all-weather strategy is designed to produce above-average risk-adjusted returns through a full market cycle. We call it all-weather because no matter what sort of market we're in, we actively manage the strategy to capitalize on attractive opportunities while also trying to shield our clients from volatility. So while all-weather looks to produce solid returns and steady current income, its main emphasis is capital preservation. Warren Buffett famously said that the number one rule for investing is don't lose money. And rule number two is don't forget rule number one. We take this idea to heart through our all-weather strategy. We manage the strategy to minimize the possibility of clients suffering a permanent impairment of their capital. One of the things that makes this strategy special is our low correlation approach. Our clients in the all-weather strategy are typically looking for a shelter from stock market volatility. We achieve that by investing with a lower correlation to the broader market. Correlation measures how assets move in relation to each other. If your investments have high correlation to the stock market, they will basically move in lockstep with each other. In other words, you are on the stock market roller coaster ride. We aim to reduce portfolio risk by looking for opportunities across several low correlation asset classes. One of our favorites is merger arbitrage. This is a strategy in which we're investing in the stock of a company that has announced it will be acquired. Given that there is always risk that an acquisition will not happen as announced, the stock of the target company usually trades at a discount to the acquisition price. This difference is called the spread. This spread often provides SAM with the opportunity to generate an attractive return over time as the acquisition gets closer to being completed. Importantly, what we love about merger arbitrage is that the return you earn has little to do with what the stock market happens to be doing in any given month or quarter. It's based on how soon and how likely the acquisition is to close. By adding this low correlation investment to all-weather, we are able to lower the risk of our overall portfolio and offer some protection to our investors from some of the pain experienced when other stocks in the market drop. We've seen the virtues of this low correlation approach during the last two bear markets. The first was in March 2020, when the market plunged in the early days of COVID. The reality is that the vast majority of investments suffered greatly during that period. For example, the S&P 500 index declined more than 33% from its high during that market crash. During the same period, all-weather investors experienced a decline of less than 14% on average. We were also able to shift gears and buy a lot of wonderful companies after the market had dropped. Per FactSet, the strategy ended the year outperforming the S&P 500 despite all-weather being a much lower risk approach. Just a few years later, we had another bear market. All-weather again proved to be a resilient strategy. Yes, it was down, but once again, per FactSet, it only declined a fraction of what the broader market experienced. Those were very different bear markets, and all-weather meaningfully outperformed the broader indexes in each. That's all-weather, growing in up markets, offering some measure of protection in down markets. If you're looking for an investment approach with less volatility, want your money to grow, and have the appropriate risk tolerance and investment objectives, the all-weather strategy could be right for you.